Alright, so welcome back to video 2 of week 2. So this next page basically is just a summary of the income statement layout. As discussed before, profit is equal to income minus expenses, but within the income statement, the income minus expenses is shown as follows. You have your sales less your cost of sales, and cost of sales is calculated as opening balance plus production costs less the closing balance. So most of you would have done financial accounting or basic financial accounting at some point, or accounting at some point, and are familiar with this layout of the income statement, and that cost of sales is calculated as opening stock plus purchases or production less closing stock. And that's basically, this layout is effectively inventory. So this whole block over here is used to calculate the cost of sales. And then what you have is sales minus cost of sales, which gives you gross profit, and then we deduct other costs and you end up with net profit. Alright, so this layout, there's two different similar layouts, but the different figures that we include when we're doing the variable costing method. So just expanding this basic income statement further, our sales would be sales as before, but our opening balance over here, as in here, would just be variable production costs, and it must be production costs because cost of sales is inventory and we produce inventory. So just variable production costs. The production cost figure over here would be the variable production cost for the year only, and then the closing balance would be based on the variable cost of the closing stock only. Alright, and then we end up again with sales less cost of sales. So this is effectively going to be variable cost of sales because these costs are all variable. Because remember, if these all gives you the calculation of cost of sales, then this figure will be the variable cost of sales. Alright, so then we end up with sales less variable cost of sales. You end up with gross profit, and then you deduct all other costs, but included in that other cost that you're going to deduct, you're going to have fixed production costs, and that gives you net profit. So what you'll see here is the fixed production costs is not effectively included in inventory, because again this whole block is inventory and it does not include the fixed production costs. So the fixed production cost is then accounted for as a period cost, as we discussed in week 1. A period cost is where you deduct the whole cost in the income statement. Whereas a product cost is where you include the costs effectively in this block of the income statement. Alright, so under variable costing, fixed production cost becomes a period cost. So not part of this block over here, but rather just a period cost that is deducted in full in the income statement. Alright, now with absorption costing, absorption is all the costs, variable plus fixed. So sales will be similar. The big differences lies with this block. So our opening balance will be variable plus fixed absorption, whereas under variable it's just variable cost. Our production cost will be variable plus fixed, and our closing balance will be variable plus fixed. Alright, now so then we have sales less cost of sales, and you'll notice that where I said less other cost here, under variable cost it said including fixed production costs. However, under absorption costing, I don't deduct. There will not be variable fixed cost to deduct again because I've already included the full fixed cost in this block over here. Alright, so if I have to deduct it over here again, then I'm going to be double counting. So, and we can't double count. So key difference is under variable costing, this block is just variable cost, and then I deduct fixed costs as a period cost. With absorption costing, these costs are variable plus fixed, and there's no fixed cost as a period cost. Alright, so that's the key difference. Yeah, and then I'm gonna end this video here for now, and then I'll come back with another video to just show you some more. Cool.